So we are going to look at disposal of financial instruments. You see, the disposal of financial instruments is just like disposal of any other what assets. So disposal of financial instruments is like maybe disposal of financial assets. It's just like disposal of any other assets, like PPE and everything. Okay. Before you can account for this disposal, what you have to do is so disposal of financial assets. We have looked at that one the last time, but I'll still talk about it again. So disposal of financial assets. Okay. So disposal of financial assets. So you are having the financial assets, you purchase the equity shares or you purchase what? A debt instrument of a particular company. You are going to classify that particular instrument as a financial asset. By the end of the day, you have financial difficulties and you have decided to dispose of the what? The instruments. And first of all, before you can go ahead to recognize the transaction as a disposal, you first have to subject the what? The transaction to the what? To the provisions of the IFRS 15, revenue from contract with customers. You first have to ask yourself, this particular transaction, can it be classified as a sale? If it can be classified as a sale, what should I look for before I can classify this particular transaction as a sale? So you first ask yourself, the risks and the maintenance, and the provisions associated with what the financial instruments has it be passed on to the third party? Has the risks associated with the what? With the instrument be passed on to the third party? If yes, it means that you don't have any right under the what? The contract associated with that particular financial instrument. It means that you have entirely disposed of what? The financial instrument to the third party. If ownership associated with the financial instrument has been transferred, the risks associated with the instrument has been transferred to the third party or the buyer, it means that you don't have any what? Obligation towards that particular instrument. You can classify that particular transaction as a sale. But situation where you are going to sell to the person, you might transfer the instrument to the person, but the person will say that any shortfall as a result of a reduction in the market value and those things, you are going to do those things to the person. It means that still the risks associated with the instrument has not been passed on to the person. So you cannot classify that particular one as a sale, but you only classify it as a financial liability because the money that you receive from the person is seen as you using the financial instrument as a collateral security to take loan from that particular third party who is the buyer. So the money that you receive from the person will be classified as additional financial liability because you're using the instrument as a collateral security to take loan. It's just like you say you are selling your car to me. I've given you money, but you are still using the car. I'm not in possession of the car. I don't have control with the car. Insurance and anything, I'm not doing the insurance. It's not as if I've purchased the car and I've given it to you to work like on commercial terms that work and pay or you work and pay to me. No. The car is still in your possession. You are still using it. You are still doing maintenance. You are still doing insurance and those things. It means that you are just using the car as a collateral security to take loan from it. So you can't recognize the money given to you as a proceeds from disposal. The car is still in your possession. Unless you have transferred ownership of the car to me, the risks associated with the car, the maintenance associated with the car has been passed on to me. That is the only time that you can recognize what? So you first have to subject the disposal, the transaction to the what? Provisions of IFRS 15. Revenue from contract with customer to see whether the particular transaction can be classified as a sale. When do we classify a transaction as a sale? When the risks, maintenance, ownership associated with the assets has been passed on to the buyer. That is the only time. You don't have any obligation. You don't have anything to do with the asset again. You have sold it and that is final. But if ownership, risks, maintenance associated with the asset has not been passed on to the buyer or has partially been passed on to the buyer, still no revenue should be recognized. But the amount received should be recognized as a loan. We are going to look at this more under the provisions of IFRS 15. Okay, let's move on to a question and see about how we can go about that particular issue. All right, let's take the question 1 under the disposal. Under the disposal.
Okay. On April 1, 2019, Santase PLC acquired 160 million of 6% listed bonds at their nominal value. Santase may sell or hold bond to maturity, and so, based on this business model, had designated the bonds as fair value through other comprehensive income. The effective interest rate on the bond is also 6%. The bonds had a fair value of 150 million at 31st March 2020 and were correctly treated in the financial statement of that year. On 31st March 2021, Santase received a coupon interest of 12 million, which was recorded within the interest received, and then sold the bond on the same day for 130 million. The disposal proceeds were substantially below the fair value of the bonds, which was 138 million at 31 December 2021. A 20 million loss on disposal was charged against profit. Santase has an option to repurchase the bond at any time up to 31 December 2022 for 135 million. The fair value is expected to increase in the future, and it is highly likely that Santase will exercise this option. Required. Discuss the appropriateness of how Santase has dealt with the bonds in the financial statement for the year ended 31 December 2021.
All right. All right. So the person is having a financial asset which is classified as what? So the financial asset is classified through other comprehensive income, isn't it? Okay. So this was purchased.
Yes.
This was purchased on what? 1st April. So the first year will be 1st April to 31st March 2020. So let's look at 31st March 2020. Let's look at how we should account for this. Let's look at, I have solved a similar question like this before, but let's solve this one too again. So let's do the accounting treatment. There's no transaction cost, and the effective interest rate is the same as the nominal rate because there's no premium. There's no premium at redemption. So, and there's no issue cost too. So that should be the case. So let's come to question 1, which is a Santase. Okay. Okay. So the initial recognition will be debit asset 160, credit cash or bank 160. Okay. So initial recognition will be the asset will be measured. We are going to have a financial asset of 160 million, where cash or bank will be credited with 160. Let's look at the subsequent measurements. So that always it is a subsequent measurement that is very important. The initial one is just the value that you are going to put, or the value that you are going to attach to the transaction at the date of what? The transaction. But subsequently, what are you going to happen? That is the most important thing. So subsequently, this will be carried to amortized cost, but at the end of every year, we fair value the assets. So what will happen is that we are going to be having the fair value, which is the nominal value of 160. Then we charge finance income. Finance income of what? That will be 6%. Okay. So 6 times 160, 0.06 times 160. What are we getting? Let me confirm that again. The effective interest rate on a bond is 6%. So the effective interest rate is the same as coupon rate. So how much are we getting?
9.6.
9.6. So it means that the coupon will still be what? 9.6. So coupon will still be 9.6 because it's the same thing. So minus 9.6. So your fair value will still be 160. So this is the carrying value at the date of this one. But let's look at, this is true other comprehensive income. So at the end of every year, we fair value the assets. Let's look at the fair value at the end of 2020. 2020, what is the fair value there? I'm sure we were given 150. Let's confirm that. Let's confirm that. Is it 150? Okay.
Yes.
So let's confirm that. Okay, that is 150. Okay. So the 150, what will happen is that it means that we are going to have a loss of what?
10.
10. So there will be a fair value loss of 10. And they say this has correctly been accounted for, which will go to other comprehensive income. They have said that already. Okay. Let's count to 2022. 2022, we will calculate our interest on the carrying value, which is the 160, because this one we are just making a provision for the what? The changes in the market, the fluctuation in the market value of the company. But with the person will be paying us interest on the 160. So we don't use the 150, we use the what? The 160, which is the actual amount which is attracting the cash flow. But the 150, we are just making provision for the what? For the down and up fall in the value of the shares. So this will still be the finance income will still be 9 point what?
That'll be 2021.
Okay, this will be 2021. Sorry. All right. Okay. So that will be 2021. Finance income will be what? Let's see. The interest should not be 12. It should be 9.6. I don't know how. But let's move on. Okay. So finance income will still be the 9.6. The coupon will still be the 9.6. Okay, so this will still be the 160. All right. But the question says that the company has received a coupon of how much?
12
Okay. But the actual amount that we should receive is what?
9.6.
So it means that since it should be 9.6, or maybe they have a problem with the percentages, but since it's 9.6, they are giving us 12 million. What will happen is that it means that they have received 2.4 in excess. So this will be classified as a current liability, because you should give us 9.6. You are giving us 12 million. So this will be a current liability of 2.4. Let's just base it on as if everything is like that. Okay, 2021. And then sold the bond on the same day for what? 130 million. Okay, and then sold the bond on the same day for 130 million. The disposal proceeds were substantially below the fair value of the bond, which was 138 at 31 March 2021. So you can see that they are now giving you you can see that they are now giving you the fair value of how much? They are now giving the fair value 138. Okay. But you have to know that at this date, this is 160. This is the normal one. But you can see that the fair value was 150. So what we do is that you take your loss, which will be the 150. So this will be the fair value now. So your fair value in the books should have been 150. Okay. But this is for 2020. Okay. We are doing like 2021 now. So the 2021, they are now giving you additional fair value of this. So what you do is that you first fair value the instrument before you sell. So the fair value 2021, they are giving you 138. So what will be the loss?
So
12 million. Okay. 12 million. So we have an additional loss of 12 million, which will go to other comprehensive income. Okay. Okay. Then the value should have been the value before the sale. The fair value is 138. And you have sold this, the disposal, because they haven't said anything about the risk and everything. So we are assuming that this is a sale. This is a sale. You can have the option to purchase the instrument, but if you have transferred the instrument to the person, it means that at the date of the option, then you purchase. But if you have the option, you are still keeping the instrument, then it means that you haven't sold the instrument. So you just classify the amount received as a loan. Okay, let's come to the disposal. The disposal was done as 130 million. So there is a loss of 8 million. So you can see that the loss on disposal is 8 million, and the fair value loss was 12 million. And that is how come they have the 20 million as a loss on disposal. But the 20 million, 12 million out of it will go to other comprehensive income, and 8 million will go to profit or loss. But you have to know this. You have to understand this. You have to understand this, that if a debt instrument is being disposed of, if a debt instrument is being disposed of, what will happen is that all the gains and losses that have been recognized in that particular or in relation to that particular debt instrument, if it is classified to other comprehensive income, all the gains that you have recognized in relation to that particular financial instrument classified to other comprehensive income, after the disposal, all the gains must be reclassified to retained earnings. What we mean is that if you have a gain of 20 million, which is relating to the instrument, which is in other reserves or other components of equity, after you have sold the instrument, we assume that the gain has been realized. Then we take it from other components of equity to retained earnings. So without reason, it means that the 12 million, which is the loss for other comprehensive income, you can decide to send it to profit or loss, because you have disposed the assets. So the loss or gain should be sent to retained earnings, or you can send this one to other comprehensive income. Then at the end of the day, you accumulate your gains, the losses, 12 million plus the first loss. 12 million plus the first loss was 10 million. So that will give you 22 million. So that will give you 22 million. So 12 plus 22. 12 plus 22. 12 plus 10 will give you 22. Then you send this 22 to, you remove it from other component of equity. How do you remove it? This was a loss. It means that it was subtract for other component of equity. So you go and add it to other component of equity to neutralize the effect of the reduction. Then you go to retained earnings and now take the 22 from it. So the loss will be reclassified to retained earnings. This is for only debt instrument. For equity instruments, the gain will be in other component of equity forever. Will be in other component of equity forever, because that is relating.
Please come again, please.
I'm saying that the reclassification is for only debt instruments. But for equity instrument, if it's a financial asset through equity instrument, upon the disposal of the instruments, the gain or the losses will not be reclassified. The meaning is that that particular gain is for the owners of the company, and that is equity. The reserve have to form part of what? Equity. So it will still be in the equity reserve. We don't reclassify to retain earnings. That's what I'm trying to say. All right. Let's count to
Okay.
factoring. Let's count to factoring. Then we close. Factoring. So we count to factoring of receivables. Factoring of receivables. Okay. Those who have done financial management, factoring is one of the what? The short-term sources of finance. Okay. People are currently owing you. Okay. You have receivables of 1,000 Ghana cedis. Okay, 1,000 million. Let me say 1,000 million Ghana cedis. Okay. And you need money to buy an asset which costs 500 million. So looking at this one, you have cash to pay, you have money to pay, just that the people have not paid you yet, or their payment period is not due. The collection period for this 100 million is not due. For 1,000 million, it's not due. So what we do is that, okay, if that is the case, we can go, since we need the money right now, we can go and sell the receivables to what? To a debt collection company and take the money to what? To pay for the receivables, or to pay for the asset that we want to buy. Or some of these customers are proving stubborn. We have tried every ways and means to get the money, but they are not paying. So what we do is that we are tired of what? Managing the receivables ourselves. We have spent a lot to collect the money, but we are not doing anything. So you have to go, if persuasion fails, force must be applied. We have to engage what? The professionals to collect the money. So what we do is that we can go and sell the receivables to get money to do whatever we want to do, or we can engage the debt collection company to collect the receivables on our behalf, or to collect the receivables for us. It's either you sell it to them or you ask them to collect it on your behalf. So we have two types of factoring. So one of them, you go to them and say that, okay, I have a receivables of 100,000 million and I want to buy something. So I want you to take the receivables and give me 800 million. So I want you to take the receivables and give me 800 million. Whether you are able to receive the remaining 200 million, I won't come for any reimbursement. So I'm just giving you the 1,000 million and that is final. I won't come for any, if you're able to receive all the money, I won't come for any additional payment again. So just give me the 800 million and that is the end. So in your, based on this, how are you going to treat the 200 million? How are you going to treat the 200 million? Which is the difference?
It will be treated as bad debt.
Yes, this will be treated as a bad debt. Okay. Because you are taking 800 million in settlement for what? 1,000 million. You are not going for any additional reimbursement again, or if they are able to collect all the money, they will not give you anything. And even if they are not able to collect the money, it is none of your business. So you have transferred the administration, the risks and everything associated with with the receivables to them. So you are out of it. You just receive a certain amount of money as final. You will not do anything again. In that case, the shortfall should be treated as what? A bad debt. And the company should not be saying that we still have receivables in our books. You have to de-recognize your receivables. So you credit your receivables of 1,000 million, you debit cash, and you debit profit or loss with what? The 200 million, which is bad debt. And this is called factoring without recourse. Factoring without a recourse. Factoring without a recourse. So factoring without a recourse, the company is going to sell. It's just like you have a car. And you are saying that, okay, Charlie, I need money. I need 500 million. So what will happen is that just take the car. Although I bought it 600 million, but I need money like very urgent. So give me 500 million and take the car. If I'm able to get the 500 million, I won't come for the car. I will not come for the car. So I'm selling the car to you and I won't come for it again. So it means that you, the one selling the car, you are going to be recognizing a loss of 100 million because you bought the car or you want to sell it for, you bought it. It's a new car. You bought it with no fault, no accident. You bought it for 600 million and you're selling for 100 million. It means that you're making a loss of what? 100 million. And that is the bad debt that we are talking about. You are selling the car, you won't come for any further amount again. That is just like the factoring without a recourse. So factoring without a recourse, the company is transferring the risks associated with the receivables, the administration of the receivables to the debt collection company, which we call the factoring company. And the factory company will just give a fixed amount to the company, a one-time amount to the company, and that is final. The company will not come for any further amount again. Even if they are able to collect all the money, the company will not go for any top up. And that is factoring without a recourse. The assumption is that you are selling the receivables of 500 million for 400 million. So you are going to have a loss of what? 100 million. Or the receivables are able to settle only 400 million out of the 500 million. So you have a bad debt of what? 100 million. So you did recognize the receivables in your books. You did recognize the receivables. That means removing the receivables from the books. So you did recognize the receivables. And the difference between the amount received and the receivables amount will be treated as bad debt. So the difference will be treated as bad debt. That is factoring without recourse. But there's another one that the factory company will tell you that, okay, the money that you are engaging, there's another one that you are engaging the factory company just to collect the money for you, but you're not selling to them. So they will say that, okay, that is fine. We are going to do this for you and we are going to charge you this amount of money. But before that, we are going to give you advance payment of 80%. Okay, within 6 months, if we are able to collect the money, we give you additional 10%. But if you are not able to collect the money, you pay the 80% plus interest of 5% after the 6 months. This one, you can purely see that the risks associated with what? With the receivables are not transferred to what? To the factory company, or the debt collection company. The issue now is if within 6 months they are not able to collect, they will come for their money plus interest. But if they are able to collect, they will also give you additional top up. They'll give you additional money. So in this case, the risks associated with the receivables is not transferred to the factory company. Therefore, the company will still be having the receivables in their books. What they will do is that it is as if they are using the receivables for a loan. They are using the receivables for a loan. So they are using the receivables as a collateral security to take loan or to take advance payment from what? From the factory company. So factoring with recourse. Factoring with recourse. Factoring with recourse. Factoring with recourse. The company will still recognize the receivables because the risk is not transferred to the factory company. If they are not able to collect the money within 6 months or within a stipulated time, they will come for their money with interest. It means that you are just saying that, okay, give me 10 Ghana cedis. Give me 10 Ghana cedis. My money is with Kofi. Help me to collect my money from Kofi. So if you're not able to collect the money from Kofi within 6 months, you bring back the debts for Kofi and say, oh, I have tried, but I was not able to collect the money. So the money that I have given to you, give my money to me. Go after Kofi and collect your own money. That is the factoring with recourse. So factoring with recourse, the company will still continue to recognize the what? The receivables and treat the amount received from the what? The factory company as loan. All right. So that is that for this one. Let's pick like one question, then we finish with that. Let's pick one question, then we finish with that. factoring. Then we know that we are done. Okay, let's look at question 1.
Jabin held a portfolio of trade receivables with a carrying amount of 4 million at 30 April 2024. At that date, the entity entered into a factoring agreement with the bank where it transferred the receivables in exchange for 3.6 million in cash. Jabin has agreed to reimburse the factor for any shortfall between the amount collected and 3.6 million. Once the receivables have been collected, any amount above 3.6 less interest on the amount will be repaid to Jabin. Jabin has they recognized the receivables and charged 0.4 million as a loss to profit or loss. Required outline the rules in Ifrs and financial instrument relating to the recognition of financial assets and discuss how these rules affect the treatment of the portfolio of trade receivables in Jabin's financial statement.
Okay. Okay. So this one, the treatments, is it correct before you even talk about the rules?
From
No.
what we just studied, it's not correct.
Okay. So it means that this is a factoring with what recourse, isn't it?
With recourse, yeah.
Okay. And the standard says that if the risks, maybe possibly the maintenance associated with what? With the receivables has been passed on fully to the factory company, then the company can derecognize the what? The receivables and charge the difference to what? Profit or loss. Or sometimes if at least 80% of the money has been given to that one, you can also base on that. But the ultimate one is the risks. Okay, so the risk over here is not fully transferred because the Joben company is liable to any shortfall or any amounts that these people, or if the people are not able to receive the money, they are responsible for the shortfall. They have to reimburse the people. So it means that the risk associated with the receivables is still with them. So therefore, they should classify the 3.6 as a loan and still recognize the what? The receivables at 4 million. That is all. So it means that they have to bring the transaction back. So bring the transaction back. What was the thing that was done? You can see that they have, let's look at the thing that they have done so that we correct it. Okay. So you can see that what was done, the transaction that was done for them is that they have debited profit or loss with 0.4. They have debited cash or bank with 3.6. And they have credited what? Receivables with 4. So what will happen is that this is not correct, so they have to bring it back. So they will now debit their receivables. They will now debit their receivables with the 4.0. Then what will happen is that they will credit financial liability, which is the loan taken. You see that the cash, whatever be the cash will be the same because they are receiving cash. So that will be 3.6. Then they will now credit their profit or loss, which by reversing the what? The loss of 0.4. So that is it. Let me see whether I want the one that we can have, which is a factoring with factory without a recourse. I want that one. Let's look at the last one and see if that is it. If that is not it, then we move on. We just leave it. So finance director recorded this and this reasonable company will be repaid to 1 in 4 months time. The payment has been made in advance and this and this. Okay. Let me pick one question on the, let me try and see whether I can have a question on that so that we move on. Let me see. answer is 2. Okay, so let's look at the question 22. Okay, question 22.
Ajara Limited has 2 receivables. That it has factored to a factoring agency. The GBB banking return for immediate cash proceeds of less than the face value of the invoices for the year ended 31 December 2020. Both receivables are due from long-standing customers who are expected to pay in full and on time. In addition, Nigeria Limited has agreed to a 3-month credit period with both customers. The first receivable is for 400,000 in return for assigning the receivable. Nigeria Limited has just received from the factor 360,000. Under the terms of the factoring agreement, this is the only money that Nigeria Limited will receive, regardless of when or even if the customer settles the debt. That is, the factoring arrangement is said to be without a recourse. The second receivable is for 200,000, and in return for assigning the receivable, Nigeria Limited has just received 140,000. Under the terms of the factoring agreement, if the customer settles the account on time, then a further 10,000 will be paid by the factoring agency, the GBB Bank, to Agile Limited. But if the customer does not settle the account in accordance with the agreed terms, then the receivable will be reassigned back to Agile, who will then be obliged to refund to the factor the original 140 plus a further 20,000. The factoring arrangement is said to be with recourse required. Advise the directors of Agile Limited on the proper accounting treatment of the monies received under the terms of the 2 factoring arrangements in the financial statement for the year ended 31 December 2020 in accordance with IFRS 9 financial instrument.
Okay, so you can see that the second part is factoring with recourse. Okay, we have done that one already. Let's look at the first part. So the first part, how should they account for?
So for the first part, we recognize the receivables. So credit receivables 400,000. We'll debit cash 360. They will debit P&L with 40,000.
Okay. All right. That is all. But for the second part, so this one you can see that the risks associated with the what? With the receivables, the administration and everything has been passed on to what? To
The factoring company.
so therefore the company can de-recognize the receivables and charge the difference to profit or loss as bad debt, as our brother has said. But the second one, you see that the risk is still with the what? With the company. So the amount received from the factory company will be treated as a loan, and if this one, they say that they will charge interest, but this one you can see that the charging of the interest will take effect from the time that the people are not able to pay. For this one, we are not certain that whether they are going to be collecting or not, since the risk is still associated with us. We will just recognize the 140 as what? As the loan. But after they are returned the receivable to us, that is the time that we can recognize the interest, because we don't know whether they are going to be collecting the money within the stipulated time or not. So after that time, if they are not able to collect the money, that is the time that we are going to pay them an interest and recognize the finance cost of 20,000. So ignore the finance cost. If ignore the what? The 20,000, because the obligation towards the payment of the 20,000 is not there. It's not that we don't have any obligation towards the payment of the 20,000. So we can't make provision for the 20,000. But there will be an obligation after the what? The elapsing of the what? The period agreed on. That is it. So you just recognize the 140 as a loan and still maintain the receivables at what? The 200,000. All right, seniors, this is the end of financial instruments, and let's see next week. Maybe we can do maybe impairment of assets or non-current asset help also. It will be between the two. So if we have any question or any concern, we can raise it here. We address it, then we move on.